This is Tom Asprey with part 3 of my video series on relative performance analysis. Today I want to concentrate on the daily relative performance analysis and why it should be looked at very closely by traders, but especially investors. In over 30 years, I've traveled around the world educating both professional investors and money managers as well as individuals. One common theme I have noted is that too many focus on the very short term, and this can often get you into trouble. As I noted in my week ahead column on Forbes on October 3rd, there were some signs that the close of prior day, October 2nd, that the market had staged an important reversal. Many were tempted to jump into those beaten down sectors like the energy sector as the rally continued the following week. This chart of the Energy Sector Select, the XLE, shows that the relative performance and the OBV both turned positive as of the close on the 2nd. However, the XLE gapped higher the following Monday, opening at 64.07, and really did not make a tremendous amount of progress over the next month and a half. As you can see, that actually on November 3rd, as it was testing its Stark bands, one of my favorite indicators for determining high and low risk buy and sell zones, it formed a divergence as the relative performance formed lower high. Though you could have made money in XLE, it was really not the best pick. If you referred back to the weekly analysis, you can see it turned decidedly negative on June 5th, stayed negative until the October lows. But even when the daily turned positive, the weekly showed no signs of a completed bottom. Remember in the earlier video, you need to see a completed bottom formation in the weekly to signal a major trend change. That did not occur in XLE. The materials sector were also hot in early October, but the daily technical studies only turned around on the 2nd. There was a good chart formation buy signal here in Wednesday, September 30th, as the XLB closed above the doji high here, giving a short-term positive signal. In this strategy, you use a stop under the doji low, which was 38.54. So if you bought on the close here at 39.62, you're risking over a little over $1. You wait until the next day's opening, you're risking another 15 to 20 cents, but you got a pretty good bang for your buck here. However, quite a few traders stayed in this trade too long. A look at the weekly chart shows that the relative performance analysis was in a solid downtrend going into the low, which was made the week of October 2nd. And while the weekly relative performance did move back above its moving average, it did not complete a major bottom formation, as it would have needed to move decisively above this resistance level to start a new uptrend. As I commented in my tweet earlier on December 29th, the XLV, the healthcare sector, staged an important breakout in today's action. This was forecast in advance by the relative performance analysis as it broke through its resistance and it started a new uptrend almost 3 weeks ago. What was missing in this environment was a more positive outlook on the stock market, as you can see that after the XLE dropped back to retest its breakout, it still had one more drop, but stayed within its longer term trading range. Just before Christmas, the technical outlook on the market changed as I posted this chart on Twitter showing potentially bullish formations in the AD line and a break of the downtrend in the McClellan oscillator. This suggested for the first time since October that a tradable low was being formed. This evidence suggested that the stronger sectors, i.e. healthcare, could finally break out to the upside. Of course, the daily RS analysis needed to be confirmed by the weekly. You can see the weekly RS line move through its moving average the week ending December 11th. That was a positive signal, suggesting that any daily signals should be treated seriously. This action that suggests that XLV can now test the all-time highs around 76.80, if not the weekly start band just above 77. Of course, the relative performance analysis can be quite valuable for stock traders as well. One stock I liked going into the opening on December 21st was Symantec, symbol SYMC, as clients were advised to purchase this on the opening at 2028 or better. Turned out it opened at 2020. You can see it had a dramatic rise. What I want to point out here is that even on Monday, when the market was down, it had a very strong up day. It was just down 6 cents at the worst point on Monday and began to accelerate to the upside. You can see that the relative performance analysis completed on a daily basis, completed its bottom right here, which was on December 7th as it moved above the prior peak. Got a pull back to the breakout level and then a good buying opportunity. The bullishness from the daily studies was supported by the weekly analysis as the RS moved above its moving average on December 18th. Now needs to surpass the October 9th high to confirm a more significant bottom, that SYMC may be a market leader as we enter the first quarter of 2016. In closing, if you're using the daily RS analysis, be sure the weekly is an agreement. Otherwise, don't be greedy. Take profits when you get them and trail your stops, as positive RS signals can reverse rather quickly if the weekly is not in agreement. Hope you found this beneficial and hope you view my earlier videos. Thank you very much.